Good afternoon and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. I'm Amanda Sylvia, and I'm the Client Service Associate for SCM, and I'm so happy to be assisting Chris today. I do want to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section specific to questions. We hope you feel comfortable to use this section to submit any questions you may have. I will ask Chris to answer as many as he can at the end of the webinar. If we do happen to run a little bit low on time and do not get to your questions, Chris or myself will reach out to you at the end of the webinar to make sure that we do get those questions answered for you. I'm so excited to introduce our speaker. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 16 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda. Good afternoon, everyone, and thank you all for joining us today. Do have to apologize to begin with. I am battling a little bit of a head cold, so if you hear some coughing in the background, and took a COVID test, all set, so nothing to worry there, but battling a little bit of a head cold there. Before we start, I just wanted to say that, I'd be remiss without mentioning Ukraine events. Our thoughts and prayers really go out to the brave people of Ukraine, and hopefully this madness, will be over soon. I also want to remind everyone before we start that all the charts and data, including any portfolio allocations, risk modeling, are as of the end of March 2022 and are subject to change. So with that, let's jump right in on what we're going to cover today. We're going to review, like we always do, historical asset class performance. And as we'll see, we did see volatility increase to start the year as financial markets, including bonds, which is kind of an interesting piece of the market because usually bonds and equities don't sell off together, but we did see that in January and February, but we did see some rebound in the equity markets in March. Then we'll take a look at the current investment environment. As we did see an increase of the overall level of risk in markets in the first quarter, it's making taking on risk a little less attractive. Then finally, we'll kind of look at how we're positioning client portfolios in this environment. And finally, we'll leave a few minutes to answer any questions you may have. As always, I would like to start off with the framework of our investment philosophy. And I don't think people do this enough because it really does help shed some light on the thought process behind all the data we're talking about and the conclusions we come to. And it really leads to a much better, fuller understanding. So for those of you who have joined me on these conference calls before, I apologize. For those new ones, I think this would be very helpful to realize that, our investment philosophy is based on, a few pillars. One, mean reversion, right? Prices oscillate around the mean. Trees do not grow to the sky. Valuation, price matters. What you pay for something does drive returns in the long term. We do believe in exposure to core factors, and they do provide excess returns above what the market can give you. And again, diversification is still the only free lunch. And most importantly, we believe risk is not stationary. It does fluctuate throughout the market cycle and really must be accounted for in client portfolios at all times. So with that in the background, let's look at Q1. And it really was not too many places to hide. In fact, the only place you could really hide was in oil or commodities. You can see that in the yellow charts, and those are the commodity asset classes. When we look across, we see fixed income in purple, US equities in blue, and international stock markets in green. Not a lot went right for financial markets in the quarter. We saw commodities were the only winners, with oil up almost 36%. They make up a big piece of that commodities, about 60% of that, so that's what that's driving up. We also saw gold as a safe haven do well in the quarter, and really driven by three key themes. Just the Russia invasion of Ukraine, which we talked about, and just the surging inflation. I don't think I have to tell anybody on this call that inflation is rising very fast and very furious. And with that rise in inflation, there's concerns about the Fed's rate hike and on the plans to combat this inflation. So we look at the quarter, we saw the S&P had its worst quarter in almost 2 years, down a little over 4.5%. And even worse, the bond market, calculated by the US bond ad, which is right here, which is just a general bond market, was down almost 6% in the quarter. And in fact, this was the worst quarter we've seen in bond markets since the launch of the index in 1986. And it's very unique since we usually don't see bonds and equities sell off together. Usually they run contra to each other. So if equities are up, bonds are down, and vice versa. So it's quite a change in this Q1. So taking a step back and looking at the overall picture in Q1, we really saw that commodity trade be the only winner, followed by inflation. There was a little bit of support there from inflation. We saw floating rates and tips not perform as worse as other parts of the market, followed by the S&P. International markets didn't do well, down almost 6%, followed by US small, which is to be expected. It's more risky part of the market. And really lagging was this duration trade represented by long-term treasuries, down over 10% in the quarter. So like we started off, not a lot of places to hide in the quarter for performance. Taking a little bit step back and taking a longer view, taking like a year-over-year, 1 year performance, like we saw in Q1, it's oil than everything else. Oil actually delivered 5 times its nearest competitor of the S&P 500, which was up a healthy, 50.5% in the year. The big difference between Q1 S&P and the 1 year S&P 500, it's that S&P 500 is still living off its strong performance on the 1 year numbers in 2021, which really did help maintain that positive year-over-year performance we're seeing. It really won't last that long at this rate, as those better performing quarters in 2021 roll off and we get some of these worse performance in 2022. But unlike in Q1, there were small pockets of positive performance, and it could be had if you knew where to look. And you can see dollar up 4, but more importantly, tips. That's that inflation trade. So we see investors worried about inflation piling into tips. Floating rate, again, you would expect with the rates rising, fixed income wouldn't deliver positive performance. But as we'll show further along in the presentation, there are pockets of the fixed income market that can do well in rising rates, and floating rates is one of them, and it showed that over the past year. International managed a little bit positive performance, almost flat, followed by the bond markets, and bringing up the rear was our friends in emerging market, really driven by, again, the Russia-Ukraine incident, and also some of the COVID lockdowns and slowing we saw in China, and some more government intervention into the equity markets by China. So overall, like we saw in Q1, commodities led the way, but over the year, followed by the S&P 500. Then we saw the inflation trade deliver some positive performance, followed by international, which maintained flat. And then we saw duration, US small, and EM bringing up the rear. So again, a little challenging performance environment, but there are pockets of opportunity if you know where to look. So moving on, and for those clients who have joined us on our previous calls, or anybody who's joined us, we view the equity markets through a factor lens, and that's that value, cheap stocks, quality, high quality, good balance sheet stocks, yield, giving income back to shareholders in size, a little bit smaller cap, and momentum, good price performance. They're really characteristics of the underlying stocks that make up the market, which is what we're looking at here. On this chart on the left, really shows the performance of these factors compared to the MSCI USA index, just a broad-based index of US stocks, and it's on a relative basis. So this is relative to that broad-based market. And you can see from the longer term chart, which is on the left-hand side right here, you can see really the only factor that has outperformed the broad-based index on a 3-year basis is quality, right? And just barely, but still some outperformance. But drilling down into this into a little bit more granular detail, I like this chart on the right-hand side. So dark blue is the trailing 3 months. That's a year to date. So as of January 1st until March 31st, trailing 12 month, the past year, and gold in that prior month. And really, despite that underperformance in March, you can see where value underperformed and yield, they have outperformed year to date. And as we'll see when we talk about the equity market, the foundation is still there for this outperformance of value and yield to continue as 2022 rolls on. So again, where you take risk matters. We're finding some pockets of opportunity, especially in the value and dividend yield pieces of the market. So I thought it'd be interesting and important for our clients, given the sell-off we're seeing, to put the current move in some historical context, and that's what I'm trying to do here with this chart. As of the end of March, the S&P 500 sell-off currently sits right around 10% thereabouts, give or take 1% or 2%, depending on the day. Well within historical ranges, according to this chart, because you can see that throughout history, there's been, since 1980, there's been intra-year declines. So that's not the end of the year, that's intra-year declines. That's these red numbers here that average 14%. And that 10% is well within that range. Nothing but normal volatility as of now. And in fact, even with this average 14% drawdown, when we look at these brown lines here, which are the actual returns of the S&P 500 in that year, we saw that 32 out of the past 42 years ended with positive returns. So the takeaway from this is sell-offs in and of themselves don't kill bull markets, and they're never fun, but do happen often throughout history. And a 10% drop by itself does not indicate the worst is yet to come. You really need to see the total picture before deciding what's going to happen as the future rolls on here. But for now, never fun. It does a little bit painful in portfolios, but well within historical norms that we've seen throughout the market cycle. One thing that provides some good indication that prices may be headed higher is the progress we're seeing on COVID. On the left-hand chart, you can see the confirmed cases really falling off a cliff, which is great. And even better, you see the fatalities really dropping down, as more people get vaccinated, as we get herd immunity. This is really helping the economy as more and more people are becoming mobile, which we can see on the right-hand chart, the real-time economic data provided by JP Morgan. You can see that top dark lines, consumer debit transactions. So that's just everything you use on your credit card. But more importantly, hotel occupancy is up. More people are going out to dinner, which I don't think I need to tell everybody on the call. If you've ever been out to dinner lately, you can see the restaurants starting to become more fuller and fuller. And if you've been near an airport lately, you can see that traffic increasing. We're seeing that in the data by that blue line. This mobility and increased spending, which are also being reflected in traditional economic data, by the way, which we'll look at, increases economic activity, which provides a positive influence on the risk environment through positive economic growth. Despite these really strong improvements in mobility and economic numbers, a potential offset to this is really the path of interest rates, which is expected to be much higher from here, as can be seen in the next chart of rate expectations. So what we're looking at here is the Fed funds rate going back to 00. And again, this is that rate that the Fed sets. It's at the low, the short end, and that's when they have the announcement. We're going to raise it 25, 50 basis points. Looking at this chart, you can see, the market may disagree on the speed of the rate hikes, but all agree the Fed is in rate hiking mode, and we don't see that slowing down anytime soon. And we're really expecting a 50 basis point rate hike next week. That's already priced into the market. That's some of the weakness we saw. So again, as long as we just get that 50 basis points, we don't see it being a big impact on the market on that announcement. And in fact, when we look out to the end of the year, we're really looking at a hike to 2.25 as of year end. This change by the Fed from its recent easing cycle to its current tightening cycle has and will continue to have a major impact on the economy and financial markets. Why? Well, the Fed funds rate is the base rate for all other fixed income. It's priced off of. So when you price credit, it's really starts with the Fed rate, and then you add risk onto that. And all else being equal, higher rates lead to lower bond prices, and we're seeing that now in the market. We saw that in price performance in Q1. And it's not only bonds, but the Fed funds rate is the base rate which all credit is tied to, including consumer. So think about things going up like mortgage rates, credit card rates. All those rates are usually variable, and they rise when the Fed raises rates. The price you pay for auto loans is going up. All headed higher as the Fed funds rate heads higher. So this is really the key rate that you really want to watch to for all those other rates that are happening in the marketplace that affect consumers, and they don't really think that far in advance sometimes. And really, the Fed has to do this. They've been backed into a corner. There's no way out other than to raise rates to combat the surging inflation we're seeing. And again, I don't need a chart to show anybody how high prices are rising. Anybody who goes to a grocery market, goes to the gas station, you can see that it's upward and onward in prices across the board. But for now, we're looking at inflation here from a headline perspective, which is blue. That's its headline CPI, which is what consumers actually feel. And the core, which is that dark line, the preferred inflation measurement used by the Fed, which really excludes food and energy. Again, they think food and energy are more volatile, but again, they don't live in the real world. They live in their models. So they use the core. You really have to go back to the 1980s to see inflation, or E.T. was the movie to see back then when these levels. And I don't think people want to remember too much in the 1980s in terms of financial market performance, but there is a big difference now between now and then, and which should provide support for the risk environment, and really the strength of the economy, which is, in growth mode now, which it was not back in 1980. So there is a difference. The intended goal of the Fed is to bring that core rate down to 2%, and that's that line right over here, all the way down to here, which, is a Herculean task. Even with the Fed doing its best to bring down that core inflation to its preferred 2% level, I don't think we'll be able to achieve this anytime soon. As support for the inflation running higher and longer really can be found in a few different data points. One is how the CPI is calculated, the labor and housing market, which continues to show strength, and the health of the consumer and corporations. So we're going to take a look at these 4 indicators, and we'll start with the makeup of the CPI, which is interesting because I don't think we do too deep sometimes into what that CPI means and what's actually making it up. And when we look at the components of the CPI index, we're looking at shelter, that's housing. People pretty much get that. Restaurants, hotels, transportation, other. There's just other goods and services. Think about what you buy on Amazon, food at home, vehicles, and energy. And we get you to that 8%. And I do like how, sticky versus transitory. And these sticky ones are the ones the Fed really can't control too much. They can help and they can hurt over the long term, but they impact more the transitory. And sticky is growing as a percentage of the price rise we're seeing. And a big piece of that is this shelter. And you can see this down here, and that's housing. When we think about the stickiness that the Fed can't control directly with rates, we see strong support for continued price increases. And it's really that shelter. And I want to take a moment to talk about that shelter because it does matter since it makes up over 1/3 of the CPI and 40% of the core CPI. So that's a huge impact. Now, you would think that given all the data out there, this would just be house prices, prices going up, and they are. And we'll show that chart a little bit later, but it's not. Like anything, the Fed likes to make things complicated, and they calculate what they call owner's equivalent rent for that. And what does that mean? Well, what it means is it's a survey. They call up the same residents of particular houses every quarter and say, if you were going to rent out your house, what could you charge? And the owner would say $1,500, $1,300, $3,000 a month, whatever that is. And that's how they calculate the cost of shelter. The big problem with that is a big lag between what the market is actually pricing in and what consumers think about their houses. Because again, they don't look at house prices every day. If you're not selling your house, it really doesn't matter if your house goes up 10 or 15%. And they're really just saying, whatever I feel like. And it takes a while for those home prices that are rising to get into that consumer's mind. So again, this is sticky. We think it has a much room to rise, even though we've seen home prices rise a lot in the past. This calculation of CPI, we think, has some legs to go due to this very strong housing market. We do see a very strong housing market, as can be seen in this chart, and we like to see that because housing creates economic activity. It points to not only increased economic activity, which is good, but also higher prices as consumers demand more goods. And you can see consumers feel confident when their house is worth more. And you can see it going up the pink line. It's just up to the right for home prices. And we can also see reaction to that by the home builders, right? They're bringing on more supply. They're starting more homes. And this green line is almost at record highs. So again, even with this little stop off in sales, you have a very, very strong housing market, which should support future economic growth. Now, turning to the labor market, we also find support econamic growth and increased inflation. And you can see that just from the numbers, this red line, unemployment rate, almost at record lows, 3.6%. So again, people are out there, they are working, and they're coming back into the labor force, which is this blue line right here. You can see the big drop off due to the COVID, people coming back in as rebounded. But you see the slow, steady rise and this big pickup we saw on the beginning of 2022 as more and more people come back into the workforce due to the receding of COVID in the marketplace. And that's translating into higher wages, which you can see that down here on the nominal rates. So again, wages are growing almost 7%, even as it's not keeping up with inflation. So again, more room to run for wages. All else being equal, more people working, higher wages, that's good for economic activity. The one pushback we get sometimes is that, well, this is a kind of backward-looking number. What about the future? Well, we look at this labor market, we don't see it slowing down anytime soon. And that's because the data. And what we're looking at here is the JOLTS data, which stands for Job Openings and Labor Turnover Survey, again, calculated by the federal government. On the left-hand side, you're looking at JOLTS job openings. If anybody wants a job, there is a job out there for them. I mean, there is almost record high job openings. And we look at the quits rate, so how many people are leaving their jobs. Again, people do not leave their jobs unless they have another job. The majority of the time, other than retirees, but the majority of the people leaving their jobs and quits need to have another job. And you can see that that's at record highs. So a lot of people are quitting and moving to new employment. And then we look at it from a company standpoint, what are they doing about the labor market? Are they hiring? Are they laying off? We look at that bottom right-hand chart right here, and they're at record lows in terms of layoffs. So they're not laying anybody off. So again, strong labor market, and there are put things in place that would continue the strong labor market as we see 2022 roll on. It's not just looking back in history. There's good support and a foundation built for a strong labor market to roll on in 2022. So another thing is, so all this is helping consumers and helping their confidence. You can see in the top chart, that's the consumer confidence number. It did drop off as to be expected during COVID. You saw the nice rise as COVID really receded into the background and leveled off here, 107, but still very elevated levels. So consumers are confident. And that's translating into action. They're actually buying things, which is the bottom here in the chart, which is retail sales year over year. As you can see, they're growing about 15% sales growth. So strong housing market, people can get a job if they want, incomes are increasing, they're confident about in the survey numbers, and that's all translating into economic activity translated through US retail sales. So consumers are in good shape based on confidence and spending habits. And again, like we look at the labor market, we don't expect this to end anytime soon because the consumer is in relatively good shape at the aggregate. And they're going to provide good support for the economy as they make up almost 70% of economic activity. So what we're looking at here is the balance sheet of the aggregate consumer. Everybody's position could be different. I mean, look at the individual, but when we take it all together, you can see that on a balance sheet, assets minus liabilities, consumers are in a good spot. And even more important, we look at the debt service ratio, which is just percent of your income that goes towards debt. We're at manageable levels of debt burden. You can see that, it's not at record lows, but it's low compared to history. And consumer savings and spending patterns, which we look on here, are back to historical norms. So again, the consumer is showing its confidence in the market by spending, and the future spending is driven by their balance sheet and the manageable debt levels. So again, no end to the consumer spending here, and we think that drives economic activity going forward. And this really isn't a US story, it really is a global story. You can see this in the heat map of global PMIs. And for those of you who haven't joined us before, PMI is a purchasing manufacturing index. It's just a survey. They call up companies and say, are things getting better, staying the same, or getting worse on a whole different categories? So, the simple observation is when you look at this, green is good. That means the economy is in expansion. And when I look across the globe here, I can see a sea of green. So again, good, strong economic activity across the board. So all the economic activity, the high, which should drive inflation, drive prices, it does keep providing support for higher rates. But higher rates don't have to be the end all, and it doesn't have to kill equity prices right away. And what we're looking at here is the historical impact of Fed tightening. We have a 6-cycle average here. We look back for the previous rate hiking cycle. Sorry about that. Say that 2 times fast. I'm going back to 77. And you can see, it's not the first rate hike that gets you, but the last. And you can see that every rate hike, it has led to recession at some point. But again, during the 6-cycle average, you have 9 hikes, 18 months. We're at 2 hikes in 3 months. So again, there was a long runway for this to happen. And when we look at the S&P 500 return during these tightening cycles, which is right down here, you can see there are some pockets of negative returns. But overall, like we mentioned, it's not that first rate hike that gets you, it's the last. They can prosper during rate hiking cycles. You can see 12%, 19, 6, 5, 8. So in the beginning of the rate hiking cycle, until the Fed tightens too much and then turns it into a recession, you can have some decent equity returns. So again, we are well aware of the rate hiking cycle, think it's going to continue, but since we're in the early stages of it, equity prices could have some more room to run here. So, looking at the weight of the economic data really points to future positive economic growth, which should provide support for financial asset prices here, even in the face of tightening rates. So now let's turn to the equity market. And we'll start, as we always do, with valuations, as that's one of the main pillar of an investment philosophy. Is valuation, what you pay for something drives returns. And look at the S&P 500 index here, a forward PE basis, and you see much improved, right? Valuation picture. Still at elevated levels compared to history, but down off its highs, which is good. And you can see what we're looking at here is not just the forward PE, which is the chart, but individual indicators. Look at the CAPE. That's a 10-year history and accounts for inflation. It's our preferred method to measure the valuation of the S&P. And you can see it is definitely overvalued, 37 to 27, 1.5 standard deviations. Dividend yield, we're at low yields here. Price to book, it's very expensive when you look at the assets of corporations. Cash flow that corporations generate compared to the price, still at very elevated levels. The only one positive for equity valuations is an earnings yield spread, and that's just comparing it to bonds, which is just comparing one overvalued asset to another overvalued asset. So again, while we did see improvement given the sell-off in Q1, we're not at really huge attractive valuation levels at the aggregate. But like we've talked about on previous calls, and you're going to hear me say over and over and over again, because I think it's so important, especially in this type of market, where you take risk matters. And while the overall market valuation is elevated, no doubt about that, there's still pockets of opportunity if you know where to look. So what we're looking at here is the same numbers, the PE ratio, left-hand chart, forward PE, but we're breaking it out between the top 10 stocks, which is the FMAGA, and includes some other ones like J&J, UNH, Berkshire Hathaway, compared to the remaining 495 stocks. And this green line is the PE ratio, same thing we saw on the other chart, but just the top 10. And you can see that it's at 30%. And why does it have such a huge impact? Because these make up almost 30% of the index. So these top 10 stocks are having an outsized impact on the valuation measures on the aggregate level. When we look at the remaining 495 stocks, which is this brown line right here, you can see it's a much more manageable valuation level, only 16 times. Again, still a little bit elevated compared to history, but much more close to normal historical levels. So again, there are pockets of opportunity to be had, and I don't think they're going to be in those top 10 for MAGA stocks. And you can see that over here where the earnings contribution, right? So down to 23%, 30% of the indices overvalued, but earnings are coming down, and now they only make up 23% of the indices. Again, not a great place to be in those top 10 names. There are some individual names that appear better than others in there when we look at a stock portfolio, but overall, you want to kind of stay away from those top 10 stocks. And another way to look at the valuation picture is to break the market into factors, because again, we're big factor believers here. You can see this on the chart from Goldman Sachs, and it's very, very easy to see right away, there are pockets of valuation support, which should help drive long-term performance of these factors. And you can see that. Look at the chart, very simple. Compared to history, not compared to any other indice, compared to itself throughout history, on the left-hand side, below zero, you're cheaper than history. On the right-hand side, you're more expensive. And you can see right away, valuation appears cheap. Dividend yield appears cheap compared to history. So those pockets could drive some outperformance as we look to 2022. Where are we finding those overvalue? Those growth, those quality numbers, quality companies, which are characterized by strong balance sheets. Those are those top 10 stocks, the FMAGA stocks, if you will. So again, those appear overvalued, which we see in the numbers. So you want to be tilting into the more attractive areas of the market, as where you take risk in portfolio matters. We want to be overweight those areas with good valuation support, those on the left-hand side of this chart, which we design portfolios to take advantage of that and be overweight those factors. So like consumers, corporations appear very healthy and are in a better position to handle higher rates and inflation than before. And what we're looking at here is profit margins on the left-hand side. So that's how much money they make after costs, taking in all their costs into account, how much do they actually keep and hopefully give back to shareholders, is about 13.4%, almost at record highs. So elevated profit margins, being able to pass on those higher prices on the consumer while making more money is relevant in the profit margins number. Look at the right-hand side, labor costs, which is a big piece. They're manageable, which is right here, which is the labor share. And again, I'm not going to comment on society about labor share of the marketplace. I'm just looking at it from a corporation's perspective. And from a corporation's perspective, at least for now, the percent of labor money going to labor is manageable and with their balance sheet. And given the sales rise they see on this bottom chart, which should continue as we see this PPI number, which is the beginning of inflation, purchases price index. So what did we start at the beginning of the supply chain? And you can see there's a 0.8% correlation with sales per share. So as inflation rises, PPI rises, sales of the S&P should rise too, which is all helps the health of the corporation. Another positive for the financial markets due to corporates is the strong expected growth of corporate earnings represented on that left-hand chart. But more importantly to us is these growth estimates, which is the right-hand chart, and that's just how many analysts are upgrading estimates compared to downgrading, and they continue to be revised higher. Even if they're leveling off a little bit, they're still positive as upgrades continue to outnumber downgrades. So looking at all this together, this ongoing health of corporations, the profit recovery, really provides support for the future direction of equity prices. And the last way we kind of look at the health of corporations is, in financial markets in general, is to look at what they cost to borrow money. Just think about this. This is corporations and what they pay for the amount for the debt on their balance sheet. If they want to invest in a new plant, if they want to invest in new employees, they go borrow money and they go to a bank, right? And banks have a vested interest in getting their money back, price out how much they're going to charge them to give them money. And that's what we're looking at here on the left-hand side of these spreads. And you can see that they're very tight. So banks aren't charging excess fees for corporations to borrow. And we can see that compared to history on the right-hand chart, we're using 20-year averages, which is this blue, for different pieces of the bond market, that they're well below historical averages. So the banks who have a very vested interest in getting their money back appear very confident about the health of corporate America, so which should provide support going forward. So again, overvalued at the aggregate level, but really some healthy corporate balance sheets could help equity prices as 2022 rolls on. So now we're going to turn to fixed income markets. And again, we can see, look at the yield curve here, and it's just the price of different borrowing going out 1 month, 3 months, 6 months, 1 year, which we call the short end, 2, 3, 5, which is kind of the belly of the curve, and 10, 30, which is the long end, with different rates, the cost to borrow. We can see the reaction of investors to the recent Fed actions and the rhetoric through the explosive rise in rates we have seen over the past quarter. And you can see that as of December, this was the yield curve. So at 2 years, you could borrow at 0.7. That's up to 2.3. And you can just see and down here, the huge changes. You can even go out further, like the 7-year was 1.4, 2.4. So you see this massive rise. And you can see that's really driving the negative performance of the bond market, because we do know that all else being equal, as rates rise, it becomes more challenging to generate fixed income performance. But like we talked about before, where you take risk matters, there are pieces that can provide outperformance, which we'll take a look at in a few slides. But again, we can see the belly of the curve. And again, that's at 2, 3, 5, 7, flattened as the short end of the curve, that 1 month, 3 month, has steepened as the Fed becomes more hawkish. We look at that long end, that 10-30, hasn't risen as much as investors are indicating. Really, that the Fed will eventually hurt growth at some time in the future. But again, remember, we're looking at 10 to 30 years here before they have to start lowering rates. So what does the yield curve tell us about the markets? It's that we're taking the Fed at its word. We think it's going to do its job. It's going to raise rates. It's going to raise rates too high eventually. It's going to hurt the economy at some point. But again, like we saw, it could be a long way down the road. And then they're going to have to start lowering rates, which is why those long end doesn't go up as much as the short end. So again, we're taking the Fed at its word. That's going to accomplish its mission and really push us into a recession at some point. But again, just like the equity markets, we can view individual areas of the bond market through a valuation lens. And we're using spread to worst. And that's just basically the yield to be expected if the worst outcome comes in the bond, which is it matures or it gets called away before the maturity date. Not seeing pockets of opportunity like the equity market, but there are parts that are more appealing than others. And you can see that leveraged loans, which is floating rate right over here, well below historical averages. US high yield, definitely below. Not looking too attractive here. And EM debt, definitely not. Some asset backs a little expensive, but some mortgage backs looking pretty attractive. So again, there's some pockets, and especially when you look at the potential impact for rising rates on bond prices, you don't want to be overweight duration. And when we talk about duration is the impact of a 1% rise in interest rates, which is that yield curve going up, all else being equal. So again, what we're looking at here is just giving a 1% potential rate rise, what happens to performance? And you can see that treasuries, especially long dated ones, which have more duration risk in it, really get hit. And even the bond market does not perform well. Again, so you really don't want to be overweight duration in a rising rate environment. But pockets of the bond market can still generate some positive returns. So even with the 1% rate rise, there are pockets down here. Again, leveraged loans pop out, asset-backed securities, some convertibles, high yields, different parts of the market that can still generate some positive returns. So we don't want to abandon the bond market entirely in the face of rising rates. We just want to be able to adjust for risk. And again, like we talked about, where you take risk matters, and active management helps. Being in those names that can adjust to rising rates, like floating rate loans, helps the portfolio a lot. You know, like we saw in the equity market, where you take risk matters. So before we jump into our risk model and looking at the risk environment through multiple lenses, I want to take a moment to talk about the yield curve inversion. It's getting a lot of press these days. I'm sure you heard about it if you watch any CNBC, or if you pick up the Wall Street Journal, even the USA Today is starting to pick it up. It's this yield curve inversion, and what does it mean? You know, the potential impact, and you know, why is it getting so much attention? And including here at Stonehearth, we do think it's really important to pay attention to this yield curve inversion. So what we're looking at here is the 10-year yield, which you just saw before on that chart. That's this blue line, and the massive 2-year yield jump. Again, we talked about the curve flattening. Short terms are going up longer than long-term rates. And what that implies, which is this gold line, is just taking the 10-year minus the 2-year. So when this gold, which I did in September 2019, breaks zero, that means the 2-year rate, the cost to lend for 2 years is higher than the cost to lend for 10 years. You know, so why does that matter, right? Now, so what? So what if it costs more? You know, why do we care? Well, we care because history shows this inversion, and when it happens, has been a very good indicator of the probability of a recession, which can be seen on this chart from Goldman Sachs. You can see on those red dots, we've had 6 inversions since, you know, the late 70s. And to follow those 6 inversions, 6 recessions. You know, batting 100, really good. It's only 6 data points, but a really good indicator of what's going on. But it does have a very long lead time. When you can look at this call out here, for those 6 incidences, you can see that the first one, 17 months into the recession hit, 10 months into the recession hit, 18 months. So you get the story here that we do have some lead time. You know, and we look at this yield curve inversion, this is not the cause of the recession, right? You know, think about it like a fever. You know, when you have a cold, the fever indicates something's wrong, something's amiss. And that's what this yield curve is doing. You know, something is amiss in the economy. And, you know, as in a normal or healthy economy, longer rates should be higher than shorter rates, right? The 10-year, you should pay more to borrow for 10 years than 2 years to compensate for the excess risk of time, right? More things can go wrong in 10 years than 2 years. So again, it's just indicating that the economy has a cold, something's wrong. So again, why do we focus at Stonehearth on these recessions, right? You know, and the yield curve inversion, because it indicates recessions. And why do we care about recessions so much and analyzing the risk environment and portfolio allocations? Again, it's history and data, you know, as the real long-lasting damage to portfolios happen during recessions. And we look at the data from Goldman to kind of prove that out here. So we see this orange line right here. That's the current episode. Like I said, 11% from the January 3rd high. And we look at 2 different outcomes. So the first one we'll look at outcome is no recession in the 12 months. That's this blue line. So this is when the market goes down 10%. If there's no recession within 12 months, what happens to performance? You see some, you know, not too good, but again, kind of capped at that 10%. But again, there are some positive things here too. But again, not that bad. Normal volatility, like we saw in that beginning chart, and that 14% drawdown intra-year on average. That's normal volatility. That, you know, diversification, managing risk can handle a little bit. The real trouble comes again with this brown line. That's when there's a recession in 12 months, and then you can see how the performance is down greater than 10%, 14, 15%. That's what really hurts. Again, so short-term volatility, normal, right? And must be endured or at least minimized by asset allocation, diversification, risk mitigation to capture the upside. But sidestepping the volatility during recessions is the key to really building long-term wealth. And granted, the chance of a recession has certainly increased. The yield curve was right. You saw that number of the yellow, it's 0. Some pundits said it did invert at 12.22 because of one trade, but in general, it hasn't inverted yet, but it's on the verge of. So again, the chance for recession has certainly increased, but when we look at the total overall weight of the evidence, from the economic data to the consumers to some of the technical pictures we're seeing, it's just not enough to tip the scales into a recession call yet. So with that, let's turn to our risk model and take a closer look into the weight of the evidence and how we came to this conclusion and what it's telling us about the current risk environment through a technical, valuation, economic, and qualitative lens. First, take a look at the technical. Definitely weakening the quarter and now leans negative. No surprises there given the weak price performance we saw, which can be seen in the bottom as we moved from, in the technical structure, from neutral to 2. And when we're looking at structure from a technical standpoint, we can go with the strongest markets are strongest when they're broad-based, which means more stocks are rising than falling. We've got the 200-day moving average right here. So some of the stocks above the 200-day. When those are higher than 50%, more stocks increasing, you see positive risk taking. We didn't see that, and we saw that move to negative in the quarter. We also saw sentiment decrease in the quarter that hurt the structured numbers. And sentiment we calculate using cyclical staples in small and large, and those pieces of the market, right? So you kind of think about it this way: if you are very confident about the future and you have positive about the economic outcomes in the market, you go to the riskier parts of the market, which is cyclicals and small compared to staples and large. So if we see staples and large cap outperforming, people are more hesitant and sentiment is decreasing in the marketplace. And we definitely saw that in Q2 and moved it down to -2. Look at the reversion number, really no change, still positive. And reversion, that's the mean reversion. Markets oscillate around the mean. They don't go to skies, long-term entry and exit levels. So again, positive there, no change, but overall the technical picture did weaken in the quarter. Even with, like we saw, even with that sell-off, valuation decreased in the quarter, and the really culprit in that is earnings revisions. And again, we did talk earlier about how strong earnings revisions are, and they have been super strong. The growth rate slowed a little bit. So the absolute level of earnings started to level off. Didn't go negative, remains neutral. So again, it's not hurting sentiment, not hurting the risk environment, but it's not helping as much as it did as earnings revisions begin to level off. And why do we care so much about valuation that we actually count it twice in our model? So, throughout history, bull markets begin when markets are cheap and they end when they're inexpensive. And that's how we try to indicate the valuation levels of the market. So for now, valuation is having a negative influence on our overall model, indicates elevated levels of risk in the marketplace. Let's turn to economics. No surprises here, really no change to the economic conditions as they remain at their max positive weight and continue to provide support for taking risk in client portfolios. And we look at economics, because it provides insight into future direction of the economy. And really the economy drives market performance over the long term. And one of the pillars, including with valuation. And we look at the economy, we look at indicators that give us clues into the future direction. We don't look behind. We don't use GDP. That tells us what happened. We don't use sales. That tells us what happened. We're looking for clues as to what's going to happen in the economy. So for that, we use copper, the price of copper. Why? It's the beginning of the production cycle. If companies are producing more, they have to go out and get copper. And they want to raise the prices. So we see rising copper prices. That means productions are increasing at the beginning of the cycle. We look at jobs, right? You don't see a recession without massive job losses. And it's really tough to get a recession when you're creating so many jobs and wages are rising. We've seen that as a positive influence on the market. We look at those ISMs, those are manufacturing indices, right? Those are the surveys to companies. Are things getting better, staying the same, or getting worse? They're not telling you what happened, they're telling you what they think's going to happen, and that leans positive. Looking at new orders, and that's just year-over-year numbers of our companies ordering more or less than they did a year ago. If they're ordering more, it tends to lead to future economic growth. So again, when we look at the economic numbers, it's an extremely positive support of the risk levels in the marketplace. We did move our qualitative indicator to negative, and the qualitative factors that just can't be captured in a quantitative model, right? This is a mathematical driven model here. There are some factors out there that we just can't capture with math, so we use our judgment framed within our quantitative framework of our history and our experience we have here at Stonehearth. Of myself, 16 something years in the marketplace. Jamie's been here 20 years. Dave Giuliano's been around 15 years as marketplace. We have a lot of experience that we can bring to bear on this. And again, given everything we've seen, the days of easy money and stimulus appear to be over, right? And the Fed will have more of a negative impact on the markets moving forward. Also, think about the ongoing invasion of Ukraine. Sorry, apologize for that. Ongoing invasion of Ukraine. The uncertainty of outcomes has definitely increased, which all leads to a more negative qualitative picture. So we look at the overall risk model is indicating increasing level of risk in markets and definitely leans negative to neutral, given everything we're seeing with the weight of the evidence. So let's take a look how this weight of the evidence is impacting or has impacted portfolio allocations. So looking at relative to Stonehearth Capital's moderate benchmark, this is a benchmark, this is a model, this isn't what actually any client portfolios, and your portfolio may actually be a little bit different. But with the weight of the evidence leaning more negative, we did reduce risk in our portfolios in the quarter. It makes sense given what we saw in the risk model, what we saw in price action. We trimmed some overseas equities, moved to neutral on emerging markets, and we used those proceeds to increase an allocation to short-term bonds, which should weather rising rates a little bit better than other pieces of the bond market. We also further reduce risk by swapping some more volatile silver holdings for our aggressive clients into gold, which is more of a safe haven asset than silver, but trades on the same kind of fundamentals, but just really a lot less volatile and provides some safe haven during times of market stress. So taking these trades, kind of what happened, we remain underweight US, no change there, a move to neutral for overseas assets. Still in the U.S. equity market, international markets still like value, still like small cap, as we showed, move away from those top 10 holdings with the mega stocks. They don't have that valuation support, and earnings seem to be coming down. In terms of fixed income, we moved to overweight fixed income with the addition of short-term bonds, but really remain cautious on duration, which we showed in all those charts, and really prefer, active management, where managers who can actually move that duration number up and down the scale as they see in the marketplace. We saw we like those floating rates, provide some good support in the rising rate environment. We see inflation going on, so we like the inflation hedges in the bond market. And also, if you can find a good bond substitute, there's not many out there, but there are a few that can throw off some income and trade like bonds. Those are good to add to client portfolios, given what we're seeing in the market environment. In terms of opportunistic, we did move to overweight in that bucket. We swapped some of our index-like equity exposure, those top 10 holdings, for more targeted thematic equity exposure. Because, as we firmly believe, where you take risk matters in this marketplace. So I'll close off my final thoughts before we get to your questions, kind of sum up what we talked about here. First, COVID, positive progress, seeing cases decline, and that's having a positive impact on the economy. Fed's in tightening mode, no doubt about it. Rates are headed higher in the near term. 50 basis points are expected next week. To year end, probably about 2.25. Low by history standards, but definitely higher than we've seen in the recent past. Why? Inflation's elevated across the board, and data keeps pointing higher for longer. Why? A strong labor market, right? Rising home prices all provide support for elevated inflation. We're also seeing strong consumer confidence, right? Healthy balance sheets, all supporting increased economic activity. Negatives, we do see valuations, right? They're stressed a little bit across financial assets, but there's some pockets of opportunity if you know where to look, and provide support for that ongoing profit recovery, provide strong fundamental support. And we look at the credit spreads, right? We don't see any signs of economic stress in the credit markets. Banks are pretty confident about the near-term future. Yields are going to continue to rise, putting stress on the fixed income market in aggregate. But like I said, with all markets, where you take risk will be much more important than the level of risk you take in portfolios. So to sum it up, risk environment weakened in the quarter, no doubt about it. Now leans neutral in the marketplace. So with that, I'll turn it back over to Amanda to see if there's any questions in the queue.
Hi, Chris. Thank you so much for all that information. So just as a reminder, there is a section on your GoToMeeting taskbar specific to questions. So we do have a couple, but if you think of any while we're going through them, please feel free to submit those. Chris, the first question we have is, given everything going on, what worries you most in today's market?
Yeah, everything. To be blunt, no. I get the question. There is a lot going on in markets, but there always is. They say the market climbs wall of worry. To me, looking at the markets right now, it's really the FRC, and that's kind of how I describe it, right? F, it's the Fed, right? Rising rates. Are they going to raise rates too much and cause an economic collapse? Which I think they will at some point. But like the data said, not now, a little bit later. But again, that's a big worry that they do something wrong and they make a policy mistake. Russia, the invasion, right? And what is the outcome? It's definitely increased the volatility, but also the range of outcomes. What is Putin going to do if he doesn't win? What's he going to do if he wins? What's going to happen to Ukraine? How's that going to impact NATO? And how does that impact supply chains and oil and energy? The range of outcomes of that is just expanded. At least on a good note, and it's kind of interesting. We listen to and subscribe to a bunch of geopolitical analysts, right, that are out there that do this for a living. And I really found this interesting lately. I know in the press, you hear a lot about on talking head press, Ukraine's winning. And I always kind of took it with a grain of salt, right? Because they had their own agenda. And when the government comes out, US government comes out, or the Ukraine government comes out and says we're winning, it's like, okay, well, you're talking your own agenda. Doesn't mean it's not true. It's just they have a vested interest. But I've heard a change of tone in a lot of geopolitical analysts lately, and they're really seeing that Ukraine really is winning, and they're doing much better than anybody thought. And you're actually seeing that when we just really agreed to release more weapons to Ukraine. So again, hopefully and thankfully, hopefully for the people of Ukraine, that ends soon. Again, it is still a big worry because the range of outcomes on that has increased tremendously. Lastly, C is China, right? It doesn't get as much press as everything else, but I mean, they're having massive COVID lockdowns. They're closing down entire cities. They're yanking people out of apartment buildings, blocking them all off. Again, the human suffering is tremendous, but it also impacts supply chains and corporations. And Apple, one of our holdings in our equity portfolio, reported last night and cited those lockdowns as impacting future growth rate because it can't get citizens back to the factories to make some of the products to get them out to consumers. So again, that's having a big troubling impact, or could potentially have one if that expands going forward. And why do they have these lockdowns when the rest of the world seems to be doing so much better? Not a knock. These is just data. That China will not take the vaccines from anywhere else other than the ones made in China, and the ones made in China have less efficacy than the ones made outside of China. So they're still in the middle of COVID a lot more than we've seen around the globe. So again, I guess the FRC, the Fed, Russia, and China are my three major worries right now.
The next question we have, Chris, is that you mentioned housing as a positive, but wouldn't that change with the higher mortgage rates?
You're right. I don't know if anybody's buying or selling, or often they look at mortgage rates, but I mean, they've exploded, right? From around, I think, 3% at the lows, maybe a little bit under, right around there. It's currently above 5%. Yeah, a headwind for sure, really, but not a knockout blow, given the current state of low inventory we're seeing, and we saw that in the prices. We do have a housing shortage in the U.S. It is real. You look around, and I think I was just reading the other day, units for sale, right? A record low, somewhere around 6% or so, somewhere around that. We're also at record lows for homeowner vacancy rates, right? And rental vacancy rates also, it's at its lowest level since 1984, right? So again, since home prices are more correlated with inventory levels than mortgage rates, I believe this will offset that slight demand destruction we'll see from higher rates. So even though 5 is very high compared to recent history, it's still relatively low when you take a longer view of mortgage rates, and just the lack of supply, lack of inventory out there should provide support for housing starts, which helps the economic activity going forward. So again, definitely concerned, but I think the positives outweigh the negatives in the housing market right now.
Chris, just want to mention here, being mindful of the time, we've got a couple more questions, but I think we'll stop right here at this last question that I have for you. And if we didn't get to yours, Chris or myself will certainly reach out to you after the webinar to make sure we do get it answered for you. But the question I have here is, given the large price decline in markets, why haven't you reduced risk more?
It's been a rough start to the year. Price decline, price, when we look at it, we use the more technical term, technicals, right? Technical piece of the marketplace. And we saw that really decrease in the quarter, and it impacted our model negatively. It's only one piece of the puzzle, and when viewing appropriate levels of risk, you know, it does point to elevated levels of risk, but we really don't believe in only using one data point, right? It tends to create blind spots and you miss a lot. And history shows, really that by viewing risk through multiple lenses and using a weight of the evidence approach, so looking at the valuations, looking at the economic environment, taking some qualitative approach, you get a much better, fuller understanding of the level of risk in markets than looking at any one data point, which tends to lead to better investment decisions. And certainly, the weight of the evidence is pointing to increased levels of risk, no doubt about it. But there are offsets that, like the macro environment, the health of the consumer we saw, corporations, that are really keeping us closer to neutral than outright bearish. We really will let the data drive our decision-making process. And that did lead us to reduce risk slightly in the quarter, given everything we're saying in portfolios. And we felt that was an appropriate amount of risk to remove from client portfolios, given the level of risk we're seeing in the marketplace when we look at it through multiple lenses and the weight of the evidence.
Chris, thank you so much. I want to thank every one of you that joined us today and have been joining us quarterly. Our next quarterly update CIO Corner will be in July. So you can head over to our website, www.stonehearthcapital.com. If you'd like to sign up for that, we'll also, of course, send out reminder emails as we get closer to that time, but we hope you can join us next time. Chris, again, thank you so much for joining us today.
And thank you everyone for joining us. Thank you, Amanda.
All right, have a good weekend. Take good care.